All right, let's talk about one of the most maddening things in trading. We're going to take that moment where you get kicked out of a trade right before it moons, and we're going to turn that into your single best entry signal.
I mean, does this feel familiar? You've done the work, you've found the perfect setup, you place your trade, set your stop loss, you're feeling good, and then, bam! This insane wick comes out of nowhere, spikes down, snags your stop to the exact tick, and then immediately roars back up in the direction you knew it would go. It feels personal, right? Like someone's out to get you.
Well, guess what? That feeling you have, it's spot on. It was not bad luck. It wasn't a random market flicker. That was a calculated move, and it's called a stop hunt. But here's the good news. Once you understand how this works, you can stop being the prey, and you can start trading right alongside the predators.
So, first things first, let's dissect this trap. We have to understand the why behind these moves before we can learn how to flip them to our advantage. And look, this isn't because you're a bad trader, it's because you haven't been taught the rules to the real game that's being played.
Okay, so what is a stop hunt? It's really just a liquidity grab. And liquidity, in the simplest terms, is just a big pool of buy and sell orders. Now think about it. If you're a huge institution, what they call smart money, and you need to buy a massive amount, you can't just click buy. You need to find a giant cluster of people willing to sell. And where's the most predictable place to find a ton of sell orders? Yep, right below those obvious support levels where everybody puts their stop losses.
Their goal is brutally simple and super effective. They just nudge the price below that key level. What happens? It sets off a chain reaction, a waterfall of stop losses from retail traders like us. This shakes out all the nervous traders, but more importantly, it creates this huge surge of sell orders that they can then scoop up, giving them the perfect entry for the real move they wanted to make all along. And right here, this is the whole game. It's a total mindset shift. When a retail trader sees support break, what's the first instinct? Panic. Oh no, it's breaking down. I gotta sell. Get me out. But smart money, they think the exact opposite. They don't see weakness. They see a manufactured opportunity. All those people getting stopped out are handing them cheap inventory right before the price is about to rally. So here's how the trap is laid, step by step. First, they push the price just below a super obvious support level. Second, all those stop-loss orders get hit, creating a flood of selling. Third, the smart money steps in and quietly absorbs all that selling, filling their giant bags. And finally, once all the sellers are flushed out, there's nowhere for the price to go but up, and it reverses hard, leaving everyone who sold at the bottom in the dust. That's the trap.
Okay, enough about the problem. We get it. Now, let's build the playbook. Let's figure out how to turn their trap into our absolute best entry signal. It's time to flip the script.
These are the exact signs you need to be looking for on your chart. First, it all starts with a support or resistance level that is just crystal clear. So obvious, you know thousands of other traders see it too. Then, you get that sudden, violent stab through the level. That's the hunt. But the real key is what happens next. A super strong, fast recovery back above the level. And often, you'll see a massive spike in volume on that recovery candle. That volume spike is your big tell. It's basically screaming that the big players just bought up everything.
So here's your 4-step strategy. And the most important word here is patience. Step 1. You see that clean support level, but you do not buy there. You wait. You fully expect the trap. Step 2. You watch for that sharp wick to stab below the level and take out the stops. Step 3, and this is your green light, you only enter after the price aggressively reclaims that level and the candle closes back above it. And finally, step 4, your stop loss goes right below the low of that nasty wick. Your risk is now incredibly small.
You see what we're doing here? The whole point is this massive psychological flip. The exact area on the chart where everyone else is panicking, where their stops are getting hit, where they're being forced to sell in a losing position, that becomes your precise point of entry. You're literally using their forced selling as your confirmation to buy. This is how you start to trade with the market's flow, instead of constantly fighting against it.
Let's make this real with an example. Let's say there's a clear support at 95 cents. Everyone sees it. The hunt begins, and the price suddenly stabs down to 92 cents, triggering all those stops. But then it recovers fast. You don't enter at 95. You wait for the confirmation and enter at 96 after it's proven itself. Now your stop loss goes just below that wick at 91 cents. So what's the result? You're risking just 5 cents per share, but your potential target could be up at $1.05 or higher. That is a professional, high-reward, low-risk setup.
You know, mastering this goes beyond just a technical strategy. It's really about developing a mindset. It takes patience to sit on your hands and wait for the trap to spring. It takes precision to act decisively on that reclaim. And it takes confidence to buy when everyone else is selling in a panic. So before you ever put a single dollar at risk, just run through this mental checklist. Number 1, is this level painfully obvious? If it is, expect it to be a target. 2, did we get that sharp liquidating wick below it? 3, was the reclaim back above the level strong and convincing? And did you see that big volume spike? And finally, do I know exactly where my entry, my stop, and my target are? If you can't check off all these boxes, just let the trade go.
So, I want to leave you with this one core idea. Stop thinking like the rest of the crowd. Instead, start thinking about where the crowd is going to be forced to exit their trades. Stop putting your stop loss in the most obvious place. Instead, start looking at that zone as your potential entry. If you can learn to trade where others get stopped out, you're going to start seeing the market in a whole new and much more profitable way.